This period was defined by the introduction of tariffs on hundreds of billions of dollars worth of imports, unsettling global supply chains, and heightening uncertainties in international markets. The discord emerged in 2018 when the Trump administration invoked Section 301 of the Trade Act of 1974 to implement tariffs, citing China's alleged intellectual property violations, forced technology transfers, and other unfair trading practices. Additionally, the United States highlighted its substantial trade deficit with China, exceeding $375 billion in 2017, as indicative of deep-rooted imbalances. The initial round of tariffs, introduced in July 2018, affected $34 billion worth of Chinese imports, including a range of machinery, electronic components, and industrial goods. In response, China imposed retaliatory tariffs on various U.S. agricultural exports such as soybeans and pork. By late 2019, the U.S. had expanded tariffs to cover $550 billion in Chinese imports, encompassing a wide selection of consumer products like electronics, textiles, and toys. China, for its part, levied tariffs on $185 billion worth of U.S. exports. These reciprocal measures drove up operational costs for American companies relying on imported materials, often shifting these expenses to consumers in the form of higher prices on everyday goods. China's countermeasures struck a particular blow to U.S. agriculture. American soybean producers, for example, saw their sales to China collapse as Beijing turned to alternative sources, notably Brazil. To mitigate these setbacks, the U.S. government dispensed over $28 billion in aid to farmers between 2018 and 2020. Multiple economic analyses revealed that U.S. consumers and businesses absorbed most of the tariff-related costs. For instance, the Federal Reserve Bank of New York estimated in 2019 that tariffs added an annual expense of approximately $831 to each American household. Simultaneously, China's exports to the U.S. dwindled in crucial sectors like machinery and electronics, prompting Beijing to respond by diversifying its export destinations and bolstering domestic consumption. Following 2 years of intensifying hostilities, the U.S. and China formalized the Phase 1 trade agreement in January 2020. As part of this deal, China pledged to buy an additional $200 billion worth of U.S. goods and services above 2017 levels, including specific targets for manufactured products, agricultural commodities, and energy resources. Beijing also vowed to tackle concerns related to intellectual property rights and put an end to forced technology transfers. In return, Washington shelved planned tariff hikes and scaled back some existing duties. However, the COVID-19 pandemic interfered with global trade patterns, and by the close of 2021, China had only met about 60% of its purchase commitments. Moreover, persistent issues such as state-sponsored subsidies and industrial policies remained unresolved. China's newly implemented extraterritorial export controls represent a significant escalation in the tit-for-tat trade and technology disputes between Beijing and Washington. By setting a precedent that foreign entities can be held liable for selling Chinese-origin goods to the U.S., China introduces new levels of uncertainty and complexity to global supply chains. While the long-term impact remains to be seen, the move signals that Beijing is prepared to use its leverage over critical resources and manufacturing capacity to counter U.S. policies, potentially shaping the contours of international trade for years to come. Strengthening ties with Russia positions China to more effectively manage and potentially win, or at least withstand a drawn-out trade war with the U.S.